Okay, hello everybody, and welcome to Investing with IBD for November 13th, 2019. I'm your host, Arusha Pierce, and with me today is Duncan Rolfe, Managing Partner for Miracle Mile Advisors. Thanks for being here, Duncan.
Thank you for having me.
On today's podcast, we are going to talk about the current markets, how fundamentals ultimately drive the stock, and we will also go over a few current ideas. So let's get into the current market. Right now, we are in uptrend markets. The main indices are hitting all-time highs. We have 4 distribution days on the S&P 500, 3 on the NASDAQ, and more stocks are starting to break out. So we do have a chance. The market seems to be getting a little bit better here. Now, Duncan, you're coming at from a different view than we look at these markets. And what are your thoughts?
Well, they all are all-time highs, and I think depending on your perspective, that can either be a warning sign or it can be, a momentum cue to the upside. We're pretty focused on global macro indicators, so we're probably a little more nerdy than a lot of firms like us.
We can get pretty nerdy here,
and when you look at a lot of the leading indicators, when you look at economic performance and health out there, we're starting to see a decent deterioration in a lot of those. When you look at the manufacturing indices, you look at some of the insider selling, CEO sentiment, a lot of those things are starting to deteriorate a little bit. And part of that, I think, has to do with the fact that we've run up so much this year. The other part's probably the fact that we're in the longest bull market run in history. And when you also have negative yields across a big chunk of the globe, people start to get a little bit concerned about how this is all going to play out. That being said...
Well, let me hold you for... We've had those negative rates for a little while now for around the globe, right? So you've had that kind of concern, especially this year, right? And the market's still...
Yeah, and I think when you get to these kind of all-time highs, no one's sitting here saying this is a screaming value right now.
Right.
I think there's a little bit like musical chairs where you kind of don't want to be the last person without the chair.
That's
and so
true.
everyone's still scarred from 2008 thinking, okay, when is the shoe going to drop? Or is this just kind of one of those longer runs like Australia had when they had like a 25-year bull market and you just kind of have to just go with it?
Right.
And I think that there is a little bit of both to this right now, which is that, at the end of the day, we're at record low unemployment. So everyone has a paycheck right now, and they're taking their paycheck and they're spending their money on stuff. And those corporations are reporting really good earnings, and that is driving stock prices up. And that could keep going for a while.
Right.
Unemployment and consumer spending, though, are lagging indicators. They're not leading indicators. And so they're the last things that are going to change when things start to go south.
True.
So we're electing to get a little more defensive at these market highs rather than kind of pile on to momentum. The problem is when you look at things from an economist perspective, more often than not, they generally tend to be wrong, especially when predicting recessions. So this could be a while, we'll see, but we definitely are getting more defensive.
Okay, and usually when you get more defensive, what are some of the strategies that you'll take, or just from a higher level?
Yeah, I mean, we work with a variety of different types of clients, and so we have a lot of everything we do is very customized. I mean, at the very basic level, though, we have reduced our equity exposure on a almost across the board for clients in favor of fixed income this year, and that's actually been a pretty solid performer because as interest rates have come down, a lot of those bonds have appreciated in value. I mean, I think the average fixed income accounts at our firm are up, close to 7+% this year. So it hasn't hurt a whole lot when it comes to performance.
Yep. Now, so how did you get started in this? What was your path that got in? Because it definitely is really interesting. And so why don't you start off? How you got into this whole crazy world?
Sure. I graduated from college back in the early 90s, so not to date myself, but I ended up investing during the tech boom. And so, then investing was, it looked like the easiest and greatest thing in the world. You take all your spare change, you put it in the market, it doubles every 6 months, and you can retire by the time I'm 32. I'd already figured it all out. But at the end of the day, part of what was going on then is I ended up getting pretty interested in technology. And to make a long story somewhat short, I actually started my own company when I was about 26. of course, using other people's money because
Right.
I didn't have any at the time. And so we raised about $35 million in venture capital. And
this was during like the whole .com.
yeah, literally,
time
we got
period.
our Series A round in April of 2000, which is the
Oh,
month
wow.
the
Wow.
NASDAQ fell off the cliff. So you guys can probably figure out the rest of the story. But but it was a very challenging environment to grow a business. So we hired 80 people in the span of 6 months. That was when, again, I grew up in an investment world back then when revenues didn't matter, profits definitely didn't matter, and so
Only eyeballs mattered
yeah,
at that
and,
point, right?
and so at the end of the day, I think when we got our money, we were going to go public within 18 months. We had no revenue. We had a lot of employees. We had a burn rate of $1 million a month, and ultimately we sold it to some distressed investors a couple years later for not very much money. I think we ended up selling it for a little bit less than we took in investment capital, which put us in like the top performers of all the VC portfolio companies for that group. But you learn very quickly that those fundamentals actually really do matter.
Yeah.
And so anyway, I got a little bit of wisdom and realized it was a lot easier to manage other people's success than to create your own success.
Yeah.
So, of course, I got into providing financial advice because that's the easiest way to manage other people's success.
So that inspired. So you started to learn. Okay, now fundamentals are really important. So you're like, okay, let me start pursuing.
Yeah, and it was interesting because our industry has changed a lot over the last couple decades. I mean, stockbroker was literally, calling people up and saying, hey, you should buy Coke,
Right.
and the next month you should buy Pepsi so that I can pay for my kid's mortgage. And that has evolved into kind of a more fee-based approach. And that evolved even further. We're an independent registered investment advisor, so we don't have a broker-dealer. We don't sell anything to anyone. We don't take transaction fees. We just provide objective advice.
Oh, interesting. Okay.
And so that's ultimately where I ended up was to, unfortunately now I'm full circle. I'm an entrepreneur again because I have my own company.
Right.
But that's kind of how I ended up in the independent channel was really the desire to provide completely independent thinking for clients rather than being tied to a larger institution.
Yeah, and that's an interesting market. I mean, it seems like be a growing market. How have you seen that evolve over the years? Or I mean, it's still somewhat a pretty new. Is it still a pretty new industry right now? Would you say? Or?
Yeah, I mean, the independent firms have been around for a long, long time. It's kind of like mom and pop convenience stores and so forth.
Okay.
It was more of a lifestyle business. What you had back in 2008 was, I think, a kind of a real breach of public trust in the larger financial institutions, several of which went out of business. And I think those marquee names that kind of equated to safety for a lot of people, really that kind of aura disintegrated. And so you had a lot of firms that really provided a huge amount of asset management services based on the fact that they were large institutions. So after 2008, people lost a ton of their money. They started looking for more independent firms and more simplistic fee structures, most importantly, and transparency in how that money was invested. And so you saw a lot of those clients leave the big brokerage firms and go to independent firms. And not surprisingly, you saw a lot of the good financial advisors who wanted to provide their clients with that same level of objectivity follow them as well. So that created this very significant uptick in independent firms in our space as money flowed out of the big firms. And today now you're seeing this being one of the fastest growing parts of our overall industry. And I think that's going to continue. I think you're going to see a lot of these independent firms now, which are very big, I mean, to the tens of billions of dollars, are going to continue to grow bigger. And you're probably going to end up with a pretty significant consolidation that happens over the next couple of years.
So these larger firms in 2008, once they lost the trust, and especially a lot of these wealthier clients started questioning the business models. Now the advisors started to leave the firms, and they took the clients with them.
That's
right?
correct.
And then
yeah.
also now you have this fragmented industry, but that's slowly.
Yeah, and I think people, I mean, this whole issue of being a fiduciary for people has become really, really important. And I think over time here, this is going to be the kind of complete migration for a lot of these firms, which is instead of really focusing on transactional revenue, again, selling stocks, the stockbroker, you're going to be more full service financial planning firms where you're doing everything from helping them set a budget to optimize tax treatment to obviously investing the money too. And so that's the direction we're seeing. And I think the technology and I think a greater degree of client awareness of that is really driving this pretty quickly right now.
Okay. And now, so you're managing a lot of wealthier clients. So that's a completely different space than a lot of our listeners are at least probably used to. What are some of the challenges that you see there now? Because you're doing a lot of full service and getting to know them, and all of them, I would assume, have to be catered specifically to their own needs.
Yeah, it's interesting that in my previous firm that I worked before we went on our own, I mean, my average client size was probably closer to $75+ million, like very, very large family offices. And on one hand, they are different and they have sometimes very different and more complicated needs.
Yeah.
On the other hand, they're people just like we are, and we all have problems. Some of them are a little different when it comes to finances,
right.
But the emotions and the behavior are very similar. And so, with us, we work with, clients with $1 million up to, hundreds of millions of dollars. Investment performance is still a very important component of things.
For sure.
Rich people tend to pay a lot more in taxes, so they tend to be a little more focused on how you can reduce that.
Yeah.
And rich people tend to be rich because they have been successful or demanding in some aspects of their life.
Right.
And we're a service provider just like all the rest of them. And so, we sometimes have to cater to unique personalities, I guess would be the way I'd say that.
Yeah, no, it makes sense. And especially a lot of these really successful people, they're used to being in control, right?
Yeah.
But now when the markets start to come unraveled, maybe not necessarily to the extreme of 2008, but 2011, you had 2015, you had a number of other corrections where things sold off pretty hard, at least in the equity markets.
No, I mean, that behavioral finance piece is really important, is that wealthier people and people who have successfully sold a business for tens of millions of dollars, they still have the same fears and the same loss aversion as the rest of us do.
Yeah.
Like I look at my portfolio and the day the market's down 2%, and I'm not a happy person.
No, exactly.
It's interesting because I think to a certain degree, a lot of the only really big difference is that the wealthier clients who have already made their money, their loss aversion, so the degree that they feel bad when the markets go down, is probably 3x what they feel good when they make $1.
Yeah.
So they're much more focused on not blowing it.
It's wealth protection at this point.
And a lot of the rest of us who are working, you're adding to your portfolio. So you're constantly, hopefully, putting money into your portfolio every month or every year, depending on what you do. And that creates a little bit of a different dynamic to the downside, but the emotions are still the same. And that's why the average return of a 401k in the United States is, I think, 2.2%. The average return of the market's closer to 8.5, 9.
Yeah.
That discrepancy is all emotional behavior.
Absolutely. Yeah. You're going to sell right at the low. You can't take the pain anymore. So the indices are at new highs. More stocks are also hitting new highs. Let's take a quick break. But when we return, we are going to talk about how you manage risk and also how fundamentals ultimately drive the stocks and other asset classes. So stay tuned. Hey, Arusha here with a big announcement. We have launched a brand new interactive video broadcast called IBD Live. IBD Live takes you behind the curtain to see how professionals trade. Log on and watch live as IBD's analysts and portfolio managers follow the first hour of market action and pick winning stocks. You get to listen to our conversations, see our screens, and ask us questions all in real time. If you've ever wanted to trade alongside a team of experts, this is your chance. Go to investors.com/IBD Live and sign up to get your first 2 weeks for free. Duncan Rolph is our guest on Investing with IBD. Okay, Duncan, let's talk about managing risk and really managing these large portfolios that you have the responsibility of.
Well, it's definitely more fun some days than others.
I would think so, yeah.
It's interesting because you really, when you think about investing money, most people think about making money on their money.
Yes.
And that's performance. That's the rate of return you make on your money. What is not captured on those brokerage statements is how much risk you're taking to make the dollar of return that you're getting. And that doesn't really matter when the markets go up, like this year.
Right.
That matters a lot when the markets go down, like last year and definitely 2008 and other years. And so a lot of times for us, and we have clients who are living off their portfolios, meaning those portfolios need to generate their income so they can keep the lights on. And we have clients who have made a fair amount of money. So again, not losing money is part of the reason why they're hiring people like us.
Yeah, you only need to get rich once, right?
Yeah, there's what I learned kind of doing this for a while is there are multiple different types of risk. There's not, when people talk about risk, it's a very nebulous term. So when we think about risk as it relates to investing, we're really talking about market risk mostly. So okay, the markets go up. That's great. The markets go down. That's risky. So if you have investments that go down when the markets go down, those are risky investments. That's really just a measure of volatility, how much something goes up, how much it goes up versus how much it goes down. It's kind of like Newton's law. If something goes up fast, it can go down fast.
Right.
That mostly holds true to almost every investment you can make. So part of how you manage risk for us is obviously the proper asset allocation, which is not news to probably most of your listeners. So if you're 90 years old and you're living off your portfolio, you probably shouldn't have every single one of your dollars in tech stocks.
Right.
You might want to have some diversification. But I think it's a little more complex than that, which is also, how do the various investments in your portfolio actually relate to each other?
The correlation.
Yeah, and the correlation can differ based on different market conditions. So are we talking about when interest rates go up? Correlations can be one way. If interest rates go down, or if we have a credit-driven recession, correlations go a different way. So how you scenario model out this, and again, this is not a science in my opinion, and I don't even think it's an art form. It's just, I think it's an evolving set of tools where you're always looking in the rearview mirror to try to learn lessons for the future.
Yeah.
But the rearview mirror is really small and the front windshield is really big.
Yeah.
And so it doesn't really give you a great, I think, ability to be very accurate on the forward-looking thinking. So that's a big part of what we do is how your different investments interact with each other. And then, there's some other risks that aren't really captured in that, and those have more to do with the types of investments that you're making. So if you're investing in a stock or a bond in your portfolio, that's public. You can buy it, you can sell it, you can do it at any second during the day most of the time.
Right.
So that's a pretty liquid investment. You own it, it's in your name. Great. As soon as you wire money into a fund of someone else's, so this applies to hedge funds, private equity, direct real estate investments, that becomes a little bit of a different risk. Now you have operational risk where you just wired a bunch of money somewhere else, and in order for that investment to work, they have to wire you your money back plus some additional money.
Right, exactly.
And so, sometimes like with Madoff, that doesn't happen. And so that operational risk is something that, we really spend a lot of time on when we're looking at more sophisticated investments for larger clients, is that, that due diligence around that is just as important as the market risk you're taking.
And what is some of the due diligence that you do? So you're going to investigate those funds really closely, how long they've been in business, all that kind of stuff? Or
you're definitely looking for, there's a variety of different components to that. And I would say that, again, not all of this is foolproof by any stretch of the imagination. Right. When you have a long-term track record and you've been doing this for a while with, a variety of accredited investors, that definitely is a good thing versus you just started out yesterday and your website still doesn't exist yet. It's under construction. Right. That's usually a warning sign. Your auditors and your fund administrator and having people who are actually looking under the hood who are reputable generally helps. But again, there's a whole lot of history is littered with a variety of funds that have had, PricewaterhouseCoopers or what have you as their auditors, and they still didn't return money to people when they should have. And then I think the terms of those investments is really important. So what they can do with your money from an investment perspective is really important. So in 2008, you put your money in a hedge fund, and they could most hedge funds, they can invest in whatever they want to, long-term options and this and that and private companies and pre-IPOs and so forth. And so at the end of the day, they can also not give you your money back
Wow.
if they feel that that's going to hurt the other investors. So in like 2008, when you had the markets come down, everyone redeemed out of these funds,
Right.
and the fund managers said, nope, I'm going to throw out my gate and I'll give you your money back in 3 years as per the document. So that also, those are the kind of risks that you want to think through is what happens when you're in a different market environment than when you're in today, where when things are going bad, how liquid are these investments? And that illiquidity risk requires a premium. You should get paid more
Right.
for an
Absolutely.
investment that's illiquid, that you might have to wait a couple of years to get your money back, than for an investment that you don't.
Yeah.
Real estate's a great example of that. Private equity, investing in direct in a company, is a great, venture capital, as I found out, is a great example of that. And so those are the kind of things that we think about when we're helping advise clients as to how or what types of investment vehicles we should invest in to meet their portfolio needs.
Yeah, and so then you're also going to conduct some scenario analysis on, okay, here's the worst case scenarios that could happen, and maybe this is the percentage that you should take a shot at that.
Yeah,
Stuff
and
like that,
it's
right?
almost like trying to, it's like a therapy session, because you're asking people like, how would you feel if this happened? And I would feel terrible if this happened. Would you slit your wrists, or is this just more like you go home and you have a drink kind of bad? And I think ultimately, like, it's important to really have honest conversations with people about people have weird relationships with money.
Yeah.
I mean,
Oh, yeah.
money can make people has historically made people do a lot of stupid stuff in life.
Definitely, yeah.
And so having that upfront discussion and really matching the math to the emotional side of this is a really important part of why a lot of people hire advisors like me.
Right, yeah, because you're going to be a little bit more objective and help them think through the process of the bad case scenarios. 'Cause it's just human nature to just think about, hey, if I put in here, I can make so much money, right? If I put in this VC firm and they're going to get in all these early new tech companies, I could make a killing at this.
Yeah, I mean, the tech bubble is a perfect example. Okay, everyone's money, like, you 10x your money in the span of 5 years.
Right.
How many people sold at the exact top? No one that I know.
Exactly.
And I know
They probably doubled down at the exact top.
well, I want it to get to this number, and now it's gone. I'm just going to wait for it to go back.
Right.
And that
Yes.
trap is total human nature. And so, professionals really, a part of their job is designed to just take the emotion out of the process to the degree that you can.
Right.
And sometimes, like 2008, I don't know anyone who was emotionless about
Right.
the outcome.
Oh, yeah. Yeah. I mean, in that scenario, the advisors have no control too. The clients, you can't control the client's emotion at that time. You can't control your own emotions.
No, you're right. You work at some of these banks, and their stock price is 3 trades away from going insolvent.
Yeah.
You're worried about your clients. You're probably also worried about the fact that your own 401k plan is about to, go up in smoke and everything
Right.
else. So no, I think ultimately that's a big part of what we help people think through. It's not just us, but all of the professionals who go out there and advise clients. And it can create very different outcomes. And people, some people, they are Warren Buffett. They're very zen. That put the statements in the drawer, and then they can kind of, as long as you're not looking at it, it doesn't happen. The tree in the woods.
Yeah.
And there's other people who, they're on their phone and they're checking. And we can see how often they check the web. The app.
Oh, God.
And it's borderline psychotic in terms of how often they look at their money. And so you have to be thoughtful about who you're dealing with when you're having these conversations.
Yeah. So now let's talk about fundamentals, because obviously 2008, the fundamentals, everything kind of came back to the fundamentals, or even 2000, as you learned, right? Let's talk a little bit about that and how they just ultimately drive in the long run.
Yeah, and I think for me that was one of the big lessons learned, was there's a big difference between the short run and the long run.
Yeah.
And back when I was had the technology company, we're hiring as many people as possible to build enough potential revenue to go public for no profits and huge losses, which is not that dissimilar to some things that have happened this year in terms of companies.
Yeah.
And ultimately, that's the short term. The fundamentals are really the longer term of how that actually plays out into profitability. And so, I think you're starting to see that same issue come up now, and you saw that with kind of the IPO market, and the appetite for IPOs changed dramatically this year.
Yes.
WeWorks and so forth, and that's because, when the momentum is there, and everyone's getting out there, and there's a lot of hype, and the markets are up. Emotion and emotion takes over, and revenues versus profits are more important. Ultimately, when you look at the market cycle over more than, say, 9 months to a year, the fundamentals ultimately are what drive stock prices. And that you could still make a lot of money in the meantime, because momentum, which is really the psychology of all this, can stay around for multiple years.
And much longer than anyone can imagine, yeah.
I mean, the housing bubble existed in 2003. It just didn't burst until 2008.
Right.
I mean, you had 5 years. And the amount of money you made in a lot of these markets, like Las Vegas, between the time it was a bubble and the time it burst, was bigger than the money you lost when it did burst. So.
Or like even a irrational exuberance with Greenspan, right?
Yeah.
In '96, he said, and then the best was yet to come.
Yeah, and it's, I think for us, ultimately, when we're looking at this for clients over the longer run, we really do focus on fundamentals, because you could be right in the short run, but you're not going to be right in the long run. Now, you could try to time it in the short run to make all of your short run decision making become a long-term gain. I don't know that many people are that good at that. I'll just say that, for the record, I'm definitely not one of those people. And so ultimately, you're trying to pick high quality companies that can grow, and you're trying to make sure your asset allocation and your risk tolerances are right. And then you are opportunistic on an event-driven basis. We had the Brexit happened.
Right.
I think we got in 5 a.m. after that night when everything broke loose over there, and emerging markets and international were down 15% in 2 trading days, and we liked them 15% ago, and so you buy more. And so those kind of events that create discounts or dislocations are an important part of how you invest money, because entry points matter.
And how much, so during those kind of extreme cases right there when the markets are plummeting, how much more were you going? Just a little bit more, or?
That's true. I think a lot of people in our business talk about these events as if they were the end-all, be-all, and they took all their money off of red and they put it all onto black, and that's just not how it happens. You're right. It is definitely a measured investment. And so I think the shift in our allocation maybe was at most 10%.
Okay.
That still makes a big difference over time,
a huge difference,
especially for some of these portfolios with big numbers. But it's not, no one's making bets that are going to bring down the house.
Well, some do. They're just not around for a while.
You can be right 3 or 4 times. I don't know that many people who are right, 15, 20 times. I mean, the casinos are there because they make money off of everyone else. It's not the other way around. And so, I mean, that's kind of how we've thought through that. And it, that does make a difference, and it works. And then you also have to know when to take chips off the table. And like I said, this year, this is starting to be that point for us as well.
So in the end, risk is incredibly important, and fundamentals will win out for any asset class that you're looking. Coming up next, Duncan and I will talk about 3 investment ideas. We'll be back. Hi everyone, Arusha here. I just hosted a free investing webinar with 2 market wizards, Mark Minervini and David Ryan. Now, these are 2 of the most successful traders in the business, and we demonstrated how professional investors sell stocks at the right time to maximize their profits and protect their portfolios. If you want to get clear selling rules and strategies straight from the pros, you don't want to miss this webinar. Go to investors.com/webinar to watch it on demand. We are back with Duncan Rolfe. Okay, Duncan, let's go over some current ideas that are on your radar. And the first one is Brookfield Asset Management, ticker symbol BAM.
Yeah, I mean, we look at a lot of different sectors, obviously, on a regular basis, and this is one of those companies that has stuck out at me as just being kind of really interesting, because it's a Canadian firm. They've been around for a long time. They're owned 20% by the insiders, which I always like.
That's always good.
Skin in the game is very important.
Definitely.
And they manage about $300 billion, and a lot of their stuff is infrastructure. So they own a ton of private equity investments, direct investments, a lot of infrastructure, solar, pipelines, etc. And so they charge a healthy fee on all of that money. So not only are they making money as an asset manager, but a lot of those investments are extremely profitable, and they're pretty active in a lot of the frontier and emerging markets, Chile and South America, a variety of other places as well. And so they've been really good at being opportunistic and going into these markets, being able to build infrastructure, create very profitable ROIs on that, and then charge fees on top of that, which always helps the total return. And they fly under the radar, so they're I don't know, in my opinion, they're not that they're a pretty good value at the current price. Again, we don't. I'm certainly not recommending any of these positions from a compliance standpoint. But when we look at these companies, they really performed well. I think their return versus the S&P the last 20 years, they're up about 16% per year. So basically over double the market. And if you look at kind of the future going forward here, especially with the low cost of capital, I think they're going to perform exceptionally well, especially as more and more people allocate more of their overall dollars to alternatives like private equity and long-term infrastructure plays.
So and you spoke about low cost of capital. They're taking advantage of all these insanely low interest rates, especially even globally, right?
Yeah. And so, ultimately that works well for people who know how to deploy capital in an effective manner and have the ability. And a lot of this also comes down to the boots on the ground to be able to go find that deal flow and capitalize on it. Whenever you're using other people's money, you're actually charging fees on top of that. That doesn't hurt the situation either when you're the general partner. So you're basically buying into kind of a general partner position with a bunch of guys who know what they're doing.
Yeah, no, that's pretty cool. I mean, on a chart level, I just pulled it up in MarketSmith here. Just a nice, steady uptrend, low volatility. Doesn't have too many crazy kind of shakeouts or anything like that. It's just a steady trend on a monthly chart. It's pretty amazing. You mentioned like 7 years of outperforming the S&P, or maybe even longer than that. I mean, it's just this unbelievable uptrend.
Yeah, and they have toll roads too. I forgot as part of that. So you look at those annuity like pipelines. You're charging, it's like a toll road for oil and gas. Right. It's the same thing. So those kind of annuity revenue streams, I think, are really attractive to investors.
Yeah, no, it makes a lot of sense. Okay, so now the second stock here is CVS, and ticker symbol is CVS. And what do you like about these guys?
Well, besides there's one very close to my house, and I have 3 kids, so I go there a lot. So I'm a big, full disclosure, I'm a big customer there. I think from a little more of a defensive standpoint, CVS kind of operates to a certain degree in this. They have like one competitor. It's Walgreens. Rite Aid is a distant third, and they have a store in almost every corner. So when you look at their business, I wouldn't call it a monopoly, but it's not that far away from that.
Yeah.
They're very, very well capitalized. They're like a $95 billion market cap, and with the migration of a lot of healthcare services into kind of the more convenience areas, like one on every corner. Right. I think you're going to see them start to add a lot more healthcare delivery services that are normally found in the doctor's office over time. And as that continues, I think they're one of the primary ones that are going to benefit from that. Now, obviously, the big 900-pound gorilla is Amazon, and when they get into prescriptions, which they're going to, I think a lot of that's already priced into where we're at right now. And Amazon, and this might be contrary to what a lot of people believe, is probably not going to take over the entire world. They only are going to take over a portion of it. Right. And so there still is enough room for the number one seed, especially in this space, to do very well. They also just partnered with UPS to do drone delivery of prescriptions. So, who knows when that's going to play out for Amazon or them. Right. It looks like it's still a little ways away. Right. But they're definitely doing all the right things to put themselves as the primary competitor to Amazon in the space.
Yeah, well, you're talking about the stock maybe pricing in all the bad news of Amazon coming in here. It looks like it's been like in a 4-year downtrend.
Yeah.
The stock right here. Before that, it had a tremendous uptrend from 2009 to 2015.
But that's why I think it's more of a value play. Yeah. It definitely is underperformed. There's no question, and I think it's a pretty good buy at this point, especially if the overall markets start to soften up here. I mean, they're in a pretty good space with a good balance sheet to be a defensive outperformer.
Yeah, and obviously a very, very strong brand name too. Okay, let's go to the third idea here, and this is a stock that you can relate to. It's Focus Financial Partners, ticker symbol FOCS. And why do you like this stock?
Yeah, this is a company that actually is specific to our industry. So we know them very well because they've been in our office a million times, and probably everyone else's in our space. So all that we talked earlier in the show about independent registered investment advisors and kind of the migration of clients away from brokerage firms to independent shops, and the migration of financial advisors in the same direction, which makes sense. So not surprisingly, whenever you have a big migration of capital, and i.e. revenues, and you have these independent shops growing and getting bigger, not surprisingly, there's going to be a firm that decides they're going to go buy a bunch of them and create an even bigger independent firm. And that's these guys. And so what they did is they partnered with some private equity guys who are pretty smart, and they went out there and started buying minority interest in independent financial advisors like us. And the interesting about how they structure the deals is they buy a percentage of the cash flows with a preference, which means that as the firms grow, they participate in the upside. And if the firms have a 2008 where they lose a bunch of revenue, they still get their pound of flesh, which means that the advisor is the one who suffers, not them. And so that creates kind of this very consistent, sustainable growth trajectory that really works. And again, they ended up going public not that long ago. Stock has definitely trended downward since that, and that's because this year has happened to be the biggest mergers and acquisitions year in our industry in like history. Period.
Oh, wow.
And that trend is continuing at an accelerating pace, not a decelerating pace. And so they're using a ton of capital right now, i.e. debt, to finance all these acquisitions, but they're buying 10, 20 plus years of future cash flow right now with this money, with very low cost money.
That's right. There you go again, the low interest rate.
And so that profitability is only going, I mean, again, I'm just giving you my personal perspective on this, is most likely going to continue to go up because as they pay off this debt, which is low cost to begin with, those free cash flows are going to continue upward. And if the markets even continue to go up a little bit, as they acquire more and more of these firms, that year-over-year growth rate is going to become a big, huge number.
So they're purchasing a part of that cash flow. When the markets go up and when these firms increase, those cash flows are just going to get larger, and so their percentage is going to go up at that point, or is it
No, that's exactly right. No, it's exactly right. So they get all the upside and basically none of the downside. And you know what? If you're going to invest in a firm, that is the business model you want to invest in.
That sounds like a pretty good business model.
And they have a good, the CEO Rudy, they have a good team, and again, we know the firm, we know a lot of other firms who have ended up doing deals with them, and they create a lot of cost synergies for these firms and some value add. And so overall, I think in our space, this is definitely a niche play. I mean, it's very specific to our industry, but our industry is kind of unique and it has consistent kind of annuity revenues. And when you can buy, like I said, a chunk of those that has the upside but not really the downside of that, that's a good buy.
What are some of the cost savings that they're giving back? Because they're buying these cash flows. What are they giving back to these firms?
The big issue for a lot of firms like ours is the back office. So the compliance costs have gone up substantially as regulation increases. The other huge piece of this is the technology, and so when you have clients are looking for more sophisticated touch points. It's not just a quarterly meeting. It's on-demand access to financial planning and portfolio analytics and a lot of stuff that ends up costing a fair amount to build out. So there's a lot of
online they want to go on and play around with some tools and figure out their own asset allocations.
And all that scenario modeling and stuff we talked about. Before it was something we did in the back office and we presented. I mean, I don't know how many trees we've killed over my career in terms of putting those books together, but this is much more, app driven and so forth. And there's the beginnings of that on the retail side with Betterment and some of these other robo advisors. That doesn't necessarily work that well when you're doing more sophisticated planning, especially with customized portfolios. Those are kind of models. So this is basically the next generation of that for, I'd say, slightly larger clients.
Okay, what do you think about the robo-advising? Because that has been a trend that's been growing and growing. I feel like I haven't heard it, but I feel like I heard about it maybe 4 or 5 years ago. Everyone's talking about robo-advising. It seems like it's kind of, I don't hear it as much maybe.
You're not hearing it as much, but it's definitely still growing fast. I think what happened is you had a bunch of highly well-funded startups like Wealthfront and Betterment who kind of made a lot of headlines with just going into the space. The ones who are really going to win, in my opinion, are the custodians. Schwab and Fidelity and Vanguard are all doing this, and they're doing it a lot better than most other people because they have gazillion clients and they have a captive audience. So I think it's the same as TurboTax. TurboTax comes out, it does your taxes. You can send your taxes online. It's the best thing in the world.
Yeah.
It's the number one preparer of tax returns out there.
Yeah.
And I still see a lot of accounting firms.
Oh yeah, I still go to an accountant. Yeah. I'm like, I'm not gonna do TurboTax.
So I think that works. It's going to be really interesting to see how those robo-advisors fare in a down market because we haven't had one basically since then. And I think there's a big difference between a person talking to someone and an algorithm talking to someone. And so that behavioral finance piece that we talked about earlier, that's going to be a big challenge for them.
For sure.
Yeah.
So there are 3 ideas to consider. Thanks, Duncan, for joining us today.
Thanks for having me.
That's it for this week on Investing with IBD. Next week, we will have Anne-Marie Band on the show. She is the CEO of TradingBook.com. And also, she's a great speaker, trader, and also an excellent trading coach. So that's it. I'm Arusha Pierce, and thanks for listening. And for this week's notes and charts, make sure to go to investors.com/podcast, where you'll find details for each episode in the podcast episode section. And make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.